The most dangerous moment in a person's financial life often arrives quietly. It does not look like a crash. It does not look like a layoff. It does not look like a medical emergency. It looks like a birthday. A person turns 50, opens the retirement account, and finally looks at the number honestly. Not the way people look at it when they are pretending everything will work out. Honestly, the account may show $200,000, perhaps $250,000, maybe a little more, maybe a little less. And for a moment he may feel proud. He should. That money did not appear by accident. It came from work, saving, payroll deductions, postponed vacations, and years of doing at least some things, right? But then the second number appears. How much will it actually take to retire comfortably at 65? Not extravagantly, not with a private jet, not with a beach house and a wine cellar. Just comfortably, with enough income to pay the bills, handle medical costs, travel a little, help family occasionally, and not wake up every morning afraid that a market decline or insurance bill will ruin the rest of life. That number may be closer to $1.5 million. Now the arithmetic becomes uncomfortable. If you are 50 and have roughly $250,000 and you need something like $1.5 million, you are staring at a gap of about $1.25 million with 15 years left. That is not a small gap. That is not a rounding error. That is the kind of gap people try not to look at, because once they see it, the old comforting answers stop working. For decades, ordinary Americans were given a simple retirement story. Save 10% of your income. Use the 4% rule. Let Social Security fill the gap. That story worked better for earlier generations than it works today. Not because earlier generations were smarter, not because today's workers are lazy. The conditions changed. People live longer. Pensions disappeared for many workers. Healthcare became more expensive. Homes became more expensive. Education became more expensive. Inflation weakened the dollar. Markets became more volatile. And Social Security is not the same kind of promise people imagined it was when they were young. The old formula was not evil. It was incomplete. And incomplete formulas are dangerous because they create false confidence. A person can spend 30 years believing he is doing the responsible thing, only to discover at 50 that he has been walking too slowly toward a finish line that moved farther away every year. So let us begin with the first old rule: save 10%. There is nothing wrong with saving 10%. It is much better than saving nothing. A household that saves 10% has already separated itself from the crowd of people who spend every dollar and then wonder why life always feels like a trap. But saving by itself is not retirement planning. Saving protects money. Investing grows money. Those are two different jobs. If a young worker saves $500 a month from age 25 to age 65 and keeps it in a low-yield savings account, he may reach something like $260,000 depending on the rate. That is meaningful. It proves discipline, but it will not fund a long retirement for most people. Now take the same $500 a month and invest it in productive assets earning a reasonable long-term return. If the return averages around 8% over decades, that same habit may grow into something closer to $1.5 million. Same monthly effort, completely different result. The difference is not work ethic, it is where the money was placed. That is why the biggest gap is often not between people who save and people who spend. The biggest gap is between people who save only and people who invest intelligently. Saving alone is not enough in a world where money loses purchasing power over time. I do not say that to insult savers. A saver is already ahead of many people, but a saver who never becomes an investor remains exposed to inflation. He stores dollars while the cost of retirement grows. He works to protect the pile, but the pile does not work hard enough to protect him. That is the first failure of the old rule. The second rule is the 4% rule. The idea sounded sensible. Build a portfolio, withdraw 4% each year, adjust for inflation, and the money should last through retirement under many historical conditions. $1 million could support $40,000 a year. Add Social Security, maybe a paid-off home, maybe a pension, and retirement could work. But today, people are living longer. Inflation has been a stronger concern. Healthcare costs are heavier, and market timing matters. If a person retires just before a bad market, withdrawing from a falling portfolio can do serious damage. The academic version of the rule may still be useful as a starting point, but a starting point is not a guarantee. A retiree who thinks $1 million automatically means $40,000 a year forever may be too optimistic. If the safe withdrawal rate is lower, perhaps closer to 3% in certain conditions, then that same $1 million produces $30,000 a year, not 40, that 10,000. Dollar difference is not theoretical. It may be insurance, groceries, utilities, prescriptions, taxes, or help for a spouse. And if inflation keeps lifting expenses, the pressure grows. So the 4% rule should not be treated like scripture. It should be treated like a tool. A tool must fit the job. If the job changes, the tool may need adjustment. The third old pillar is Social Security. Many households still lean on Social Security heavily, and I understand why. It is one of the largest retirement income sources in the country. It pays for life. It adjusts for inflation. It gives many retirees a foundation they could never build privately. But Social Security was never supposed to be a luxury retirement plan. It was meant to be a floor. And even that floor is under pressure because the system is funded by workers paying for current beneficiaries. The money coming out today is largely supported by payroll taxes from workers today. It is not sitting in a personal investment account with your name written on it. Demographics matter. If there are fewer workers relative to retirees, the math tightens. If people live longer, benefits must be paid longer. If the trust fund reserves run down, Congress has to act or scheduled benefits may be reduced. That does not mean Social Security disappears entirely. Payroll taxes will still come in. Benefits will likely continue in some form, but relying on the full projected benefit without any margin of safety is not prudent. If you are 50, you do not have the luxury of pretending government promises are the same as personal capital. You must take retirement into your own hands, not because the government is evil, because arithmetic is indifferent. Now let us discuss what changes after 50-50 is not too late. It is not early either. That means you must act with both urgency and discipline. Panic will not help. Reckless speculation will not help. Pretending everything is fine will not help. What helps is using every legal advantage available and then directing the money into assets with a clear job. Once you reach certain ages, the tax code gives you catch. Up to tools, these are not a magic, but they are valuable. A person who ignored them may leave thousands of dollars. Of annual tax advantage saving on the table. That is foolish when time is already limited. One tool is the IRA catch-up contribution. If you qualify, a Roth IRA can be especially attractive because the money goes in after tax, grows tax-free, and can be withdrawn tax-free later. If the rules are met for someone who expects higher taxes in the future or someone who values tax-free flexibility in retirement, Roth money can be very useful. Once you reach the catch-up age, you may be allowed to contribute extra. That extra amount will not close $1 million gap by itself, but it can help. More importantly, it forces you to treat the last 15 years before retirement as a serious accumulation period. At 50, every available account should be reviewed: traditional IRA, Roth IRA, 401k, Roth 401k, health savings account, taxable brokerage, real estate equity, cash reserves, debt. Each account has a different tax character. The wise household does not look only at the total number. It looks at where the money sits and how it will be taxed when needed. A second tool is the health savings account if you are eligible. Most people think of an HSA as a medical spending account. The wealthy and financially educated often understand that it can be much more powerful. Money may go in tax-free, grow tax-free, and come out tax-free when used for qualified medical expenses. That is a rare triple tax advantage. And medical expenses in retirement are not a small issue. As people age, healthcare becomes one of the largest financial uncertainties. Premiums, deductibles, prescriptions, dental care, long-term care, and out-of-pocket costs can become serious. An HSA can become a medical war chest if used properly. Again, this is not magic. You must be eligible. You must follow the rules. You must keep records. But if you qualify and can fund it, ignoring it is unwise. A third tool is the backdoor Roth IRA for higher earners, where appropriate, higher income workers may not qualify to contribute directly to a Roth IRA. But under existing rules, some may contribute to a traditional IRA and convert to Roth depending on their tax situation and the pro rata rules. This is not something to do casually if you have existing pre-tax IRA balances. It can create unexpected tax consequences. But for the right person, with proper advice, it can help build tax-free retirement assets. The lesson is not that every person should use a backdoor Roth. The lesson is that high income is not an excuse to ignore tax structure. The fourth tool is the 401k catch. Up for many workers, the 401k is the main retirement vehicle. Once you reach 50 catch, up contributions allow you to put more money away each year later. For those in the special early 60s window under current rules, catch-up limits may rise even more. That matters because the final 15 years before retirement often include peak earning years. The children may be older, the mortgage may be smaller, income may be higher. The household may finally have room to save aggressively. If that room exists, it must not be wasted on lifestyle upgrades that make retirement harder. That is one of the great traps at 50. A person finally earns more money and decides he deserves a better car, a bigger vacation, a larger house, or more visible status. Then the very decade that should have rescued retirement becomes the decade that locked him into higher expenses. Do not do that. At 50, an extra dollar invested may be more valuable than an extra dollar spent trying to prove something. You have less time than you did at 25. But you still have time, and time combined with tax-advantaged contributions, strong income, disciplined expenses, and sensible assets can still change the outcome. Now we come to the 5 kinds of assets a person should understand before 50. The first is growth. A retirement portfolio needs some engine for growth, especially if the gap is large. For many ordinary investors, the simplest way to own growth is through broad exposure to the American economy. A low-cost SP 500 fund gives ownership in many of the largest publicly traded companies in the United States. It is not perfect, nothing is, but it is diversified, understandable, and historically powerful over long periods. When one company weakens, the index eventually changes. A fallen company can be replaced by a stronger one. The investor does not have to pick every winner individually. He owns the machine. That is why broad index investing can be so useful. It is not clever, it is not glamorous. It is not a private deal whispered at a country club. It is simply ownership of productive enterprises at low cost, and low cost matters. Fees that look small can devour enormous wealth over decades. A person near 50 cannot afford to pay unnecessary fees for products that do not improve his odds. For someone who wants more growth and can handle more volatility, the NASDAQ 100 or technology-heavy exposure may be considered, but there is a trade-off when markets rise. Growth-heavy indexes can rise faster. When markets fall, they can fall harder. The person who cannot stomach a large decline should not pretend to be aggressive during good times and become a coward during bad times. Risk tolerance is not what you say at a dinner table. Risk tolerance is what you actually do when your portfolio is down 30%. The second asset category is income. Growth builds the pile. Income helps you live from the pile. A person approaching retirement must eventually ask a very plain question. If I stop working, what pays the bills? One answer is selling investments each year. That can work if managed properly. But many people are uncomfortable relying entirely on selling pieces of their portfolio, especially during down markets. They prefer assets that send income into the account. Dividends, interest, rents, distributions. A well-built income portfolio can help reduce the feeling that every bill requires selling an asset. Dividend growth funds may own companies that not only pay dividends but have a history of increasing them. That can be useful because retirement expenses do not sit still. Inflation pushes them higher. A dividend that never grows may quietly become weaker. A dividend that grows faster than inflation can help protect income. But do not worship yield. High yield can be a warning sign. A dividend is only valuable if it is supported by real earnings and cash flow. A company paying an unsustainable dividend is not generous. It is sending a distress signal. Income investing should be done with quality, diversification, and patience. The goal is not the highest yield on the screen. The goal is dependable and growing cash flow from assets that can survive different economic environments. Funds like dividend growth ETFs may be useful for some investors because they diversify across many companies. They do not eliminate risk, but they reduce single company risk. The income may not be huge at first. That is why the work must begin before retirement, not after you build the income engine over time. The third asset category is real estate. Real estate deserves careful thinking because it can either build wealth or trap a household. The home you live in is not the same as investment real estate. Your home can be valuable. It can give stability. It can help you avoid rent increases. A paid-off home can reduce retirement expenses dramatically, but a primary residence does not automatically produce income. It also demands maintenance, insurance, taxes, repairs, and sometimes large surprises. Buying too much house is one of the easiest ways to look successful while becoming financially weaker. A house should serve your financial life. It should not consume it. Investment real estate is different. A rental property can produce monthly cash flow if bought correctly. It can appreciate over time. It can allow the use of sensible fixed-rate debt. It can provide tax advantages such as depreciation. It can benefit from inflation if rents and replacement costs rise. But real estate is not passive, just because people use that word carelessly. Tenants, repairs, vacancies, property managers, insurance, taxes, local laws, financing, and unexpected costs all matter. A bad property with bad numbers is not an investment. It is a job with debt attached. The investor must buy based on cash flow, reserves, location, financing, and risk. If the property only works under perfect conditions, it does not work. For those who do not want to manage physical property, real estate funds or REIT ETFs may provide exposure. They will not provide the same tax treatment as direct ownership, and they do not give the same control, but they can offer diversification and convenience. Again, the point is not that everyone must own rental property. The point is that real estate can be one leg of a retirement stool if handled intelligently. The fourth category is aggressive growth. This is where people must be careful. If someone reaches 50 and feels behind, the temptation is to gamble. He says, "I do not have enough time, so I need a big win." That sentence has destroyed many retirement plans. Being behind is not a good reason to become reckless. In fact, it is a reason to become more disciplined. But a small portion of a portfolio may be used for higher growth themes if the person understands the risk. Small cap companies, semiconductors, artificial intelligence, infrastructure, energy transition, nuclear power, Bitcoin, or other digital assets, and similar themes may offer upside. They also carry volatility, valuation risk, hype risk, and the possibility of permanent loss. The key word is small. A speculative sleeve can be acceptable. A speculative retirement plan is foolish. If you put a modest percentage of your portfolio into higher risk assets and they do well, they can help. If they fail, they should not ruin you. That is how an adult sizes risk technology may keep growing. Semiconductors may remain essential. AI may require more chips, more power, more data centers, more infrastructure. Nuclear energy may become more attractive if electricity demand rises. Small cap value may eventually recover if the rate environment improves. Bitcoin may serve as a hedge for some investors who believe in its scarcity and adoption, but none of these ideas are guaranteed. A theme can be correct and still produce poor returns if the price is too high. A technology can be revolutionary and still disappoint investors. A small company can have potential and still fail. A crypto asset can rise dramatically and fall brutally. So the investor must use position sizing, diversification, and a clear understanding of what he owns. At 50, you are not playing with casino chips. You are playing with years of your future freedom. The fifth category is insurance. I do not mean insurance as in a product sold by an agent in a shiny brochure. I mean portfolio insurance, assets that may protect you if the dollar weakens, inflation persists, the U.S. market disappoints, or the economy goes through a period of stress. Gold is one example. I do not think of gold as a productive investment the way I think of a business or rental property. Gold does not invent, hire, sell, earn, or pay a dividend by itself. It sits there, but for thousands of years, people have treated it as hard money, a store of value, and a hedge against currency distrust that can make it useful in modest amounts. But gold is volatile too. It can fall. It can disappoint for long periods. It should not be confused with a business that produces income. It is a hedge, not a wealth engine. International diversification is another form of insurance. Many Americans have most of their wealth tied to the United States. Their job, home, currency, stock portfolio, and future benefits may all depend heavily on one country. The United States has extraordinary advantages, but no country deserves blind faith with every dollar you own. International funds can provide exposure to developed markets, emerging markets, or specific countries. This does not guarantee better returns. Foreign markets have their own risks, currency, politics, governance, accounting, slower growth, and regulation. But diversification outside the United States can reduce dependence on one economic system. The purpose of insurance assets is not to dominate the portfolio. It is to protect against the possibility that your main assumptions are wrong. A person who has all wealth in one country, one currency, one sector, one employer, and one market is not diversified. He is concentrated and does not know it. Now, how should these categories fit together? That depends on the person, a 50-year-old with high income, low debt, strong savings, good health, and a long work runway can take a different approach than a 64-year-old with no margin for error. A person with a pension can take different risks than someone with no guaranteed income. A person with a paid-off house has different needs than someone carrying a large mortgage into retirement. There is no single portfolio for everyone, but there is a universal order of thinking. First, know the gap. What do you have? What do you need? When do you want to stop working? What income will Social Security likely provide? What if it is lower? What fixed expenses will remain? What healthcare costs might appear? What debts must be eliminated? Second, use the tax advantage tools available. If you can make catch-up contributions, consider them. If you are eligible for an HSA, understand it. If a Roth strategy makes sense, evaluate it. If your employer offers a match, do not ignore it. If you are self-employed, look at retirement plans for business owners. Taxes are one of the largest expenses in a financial life. The less unnecessary tax friction you create, the more capital stays working. Third, build the asset mix. Growth for appreciation, income for cash flow, real estate for inflation protection, and potential tax advantages. Aggressive growth in controlled amounts for upside, insurance assets for diversification and protection. Fourth, avoid destroying the plan with debt and lifestyle. A 50-year-old who invests well but keeps borrowing badly is trying to fill a bucket with a hole in it. High-interest debt must be attacked. Lifestyle inflation must be controlled. Retirement is not funded by what you earn. It is funded by what you keep and what that kept money becomes. Fifth, be realistic about risk. A person who needs to earn impossible returns to retire comfortably has a spending problem, a saving problem, a time problem, or all three. The answer may not be taking more risk. It may be working longer, saving more, downsizing, moving, reducing expenses, building a side income, or changing expectations. That may not be pleasant, but unpleasant truth is better than comfortable failure. Now, let us talk about starting late. A person at 50 with a retirement gap may feel ashamed. That emotion is understandable, but it is not useful. Shame looks backward. Retirement planning requires looking forward. You cannot compound money. You did not invest at 25. You can compound the money you invest now. You cannot recover every missed year. You can stop missing new ones. The next 15 years may not be enough to do everything you dreamed of, but they may be enough to dramatically improve the outcome if you act seriously. Save aggressively, invest intelligently. Use catch. Up contributions, reduce debt, build income assets, control spending. Consider working a little longer if the math demands it. Avoid speculation disguised as rescue. This is how a late starter becomes a serious planner. The worst thing a late starter can do is swing for the fences with money he cannot afford to lose. The second worst thing is to do nothing because the problem feels too large. The correct response is disciplined intensity. You must become serious, not desperate. There is a difference. Desperation buys lottery tickets. Seriousness builds a plan. Now consider the role of inflation. Inflation is the reason cash cannot be the whole plan. It is also the reason income growth matters. If your dividends, rents, or business income do not grow over time, retirement becomes harder. If your portfolio is too conservative too early, it may fail to keep pace with the rising cost of living. If your spending is too high, inflation magnifies the weakness. A retirement plan should be built to fight inflation, not pretend it will behave. That is why growth assets are still needed even near retirement. Many people become too conservative too quickly because they fear market volatility. But the opposite risk is running out of purchasing power over a 30-year retirement. A 65-year-old may live to 95. That is 30 years. 30 years is long enough for inflation to do serious damage. So the portfolio must balance two enemies: market decline, inflation. Too much stock risk can hurt you in a crash. Too little ownership can hurt you over decades. That is why planning is more important than slogans. Now, I want to address the idea of income investing again because it appeals to many people near retirement. They want checks. They want visible cash flow. They want to avoid selling shares. That instinct is understandable. But do not chase yield blindly. A 10% yield can be a gift or a trap. If the underlying business cannot support it, the dividend may be cut and the share price may fall. High income with weak principal protection is not safety. A good income asset should have the ability to keep paying. A better one should have the ability to grow the payment. Quality matters more than headline yield. Real estate income has the same rule. A property with high advertised rent but poor tenants, weak location, bad maintenance, rising taxes, and expensive insurance may not produce the cash flow you expected. Cash flow must be calculated honestly after all expenses, reserves, vacancy, management, repairs, and financing. Numbers that work only on a sales brochure do not count. Now, aggressive growth deserves one more warning. If you are 50 and behind, you may be tempted by the newest theme, AI, Bitcoin, semiconductors, nuclear, small caps, biotech, anything with a story large enough to cover the fear in your stomach. Stories are powerful, but the portfolio must not depend on one story. The right question is not, could this go up a lot? Many things could. The right question is, what happens if I am wrong? If the answer is that retirement is ruined, the position is too large. Successful investing is not only about upside, it is about surviving your mistakes. At 50, survival matters. Now, let us bring this back to the old retirement formula. Saving 10% may not be enough. The 4% rule may need caution. Social Security may not fill the gap the way earlier generations hoped. Therefore, the modern retiree must become more active in designing the retirement machine, not more frantic, more informed. The machine needs tax-advantaged accounts, it needs growth, it needs income, it may need real estate. It may allow a controlled amount of aggressive upside. It needs insurance against inflation, dollar weakness, and country concentration. It needs lower debt, it needs spending discipline, it needs flexibility, and above all, it needs ownership. A paycheck stops when you stop working. Assets can continue. That is the difference between labor and capital. The person who reaches 50 without enough capital must convert as much future labor as possible into capital quickly and intelligently, not by gambling, not by chasing, by capturing income, investing it, and letting the right assets do their job. If you still have 15 years, you have roughly 180 monthly opportunities to contribute, adjust, and improve. Do not waste them. Each month can buy ownership, each raise can increase contributions, each unnecessary expense can be redirected, each debt payment eliminated can free cash flow, each tax strategy can keep more dollars working, each year of discipline can move the retirement outcome away from fear and toward control. That is not glamorous, but it is powerful. The modern retirement crisis is real because too many people were taught a formula that no longer fits the world. They saved too little, invested too late, relied too heavily on Social Security, underestimated inflation, and believed retirement would somehow work itself out. It will not work itself out. You must work it out. And the sooner you do the math, the more choices you have. At 50, the question is no longer whether retirement planning is interesting. The question is whether you want your older self to depend on hope or on a system you built while you still had time. I would choose the system, know your gap, use your catch-up tools, own growth, build income, treat real estate carefully, take controlled risk where it makes sense, hold insurance assets where they serve a purpose, keep costs low, keep debt down, keep learning, and stop waiting for a perfect retirement formula to save you. The old rules were not enough. The new rule is ownership with discipline. That is how a person who feels behind at 50 can still fight for a retirement worth having. Not lavish, not reckless, but secure, flexible, and built on assets instead of promises. And in a world where promises keep getting more expensive, assets are what I would rather own.